Hello everyone and welcome back to the lesson. Today we are going to answer the last question that was tested in December 2023. So far we've done question 1 up to question 4. Today we attempt the last question, which is in two parts, part A and part B. Part A reads, highlight 6 reasons why it is necessary to make adjustments to accounts at the end of the accounting year. 6 reasons. Reasons why it is necessary to make adjustments to the accounts at the end of the accounting period or the accounting year. Why is it necessary to make adjustments to the financial statements at the end of the accounting year? Candidates, there are various reasons why it is necessary to make adjustments to accounts at the end of the accounting year. The first reason is the matching principle. Now, adjustments, candidates, help ensure that revenues and expenses are matched to the period in which they were incurred or earned. When preparing the financial statements, the accountants ensure that the revenues that were earned within that accounting period match with the expenses that were incurred. So adjustments are necessary so that this matching principle is adhered to. And this principle states that expenses should be recognized in the same period as the revenues they helped to generate. So if you have sales as revenues or interest or any form of income, that income has to be matched with the expenses that helped generate that revenue. That is the matching principle. And that's one reason why it is necessary to make adjustments to the accounting period such that the expenses that are being incurred that are not for the present period are not included in the present period, because there are times when candidates expenses that may be paid that do not relate to the current period. So such expenses should be deferred to the subsequent period. So that's why it's important or necessary to make adjustments to the accounts at the end of the accounting period. The second reason is accrual accounting. Many businesses use accrual accounting, which requires recognizing revenues and expenses when they are earned or incurred, regardless of when cash exchanges hands. And therefore, adjustments help reflect these transactions in the financial statements. Accrual accounting. 3, recognition of revenue. Some revenue may be earned but not yet received in cash. So adjustments ensure that these revenues are recognized in the appropriate period, which then provides a more accurate depiction of the company's financial performance. Expense recognition. Expense recognition. Now, similarly, candidates, certain expenses may be incurred but not yet paid. Some expenses may be incurred but not yet paid. For example, a company may use premises for the landlord without paying. Or a company may use the services of employees but fail to pay salaries and wages. So those are expenses that are incurred but not yet paid. So adjustments ensure that such expenses are recognized in the period they contribute to generating revenue and therefore improving the accuracy of the financial reporting. 5, accurate financial reporting. Now, adjustments ensure Financial statements present a true and fair view of the company's financial position and also the company's financial performance. And therefore, without adjustments, certain income or expenses may be understated or they may be overstated, leading to misleading financial statements. And therefore, it's important or necessary to make adjustments to the accounts so that the accounts portray a true and accurate financial position of the organization. 6. Compliance with accounting standards. Now, many accounting standards and regulations require adjustments to be made at the end of the financial period and ensure that there is compliance. And therefore, following these standards is essential for maintaining transparency, maintaining credibility in financial reporting. So adjustments may be made because there are certain transactions that are meant to be made in compliance with accounting standards. There's also tax compliance. Tax compliance. Tax compliance. Adjustments may also be made in order to comply with the taxation laws. And tax regulations often differ from accounting standards, and therefore adjustments may be required to reconcile the differences between the financial reporting and tax reporting. You are aware of the preparation of the income statements for tax purposes. The accounting that is necessary for reporting may be different from accounting for taxation purposes. So adjustments may also be necessary for tax compliance purposes. So adjustments be made to the accounts at the end of the accounting year in order to comply with tax regulations. So these are some of the reasons why it is necessary to make adjustments to the accounts at the end of the accounting period. And in summary candidates, making adjustments to accounts at the end of the accounting year is essential for ensuring accuracy, ensuring compliance, and also transparency in the financial reporting, which ultimately supports better decision making and the shareholders' trust, stakeholders' trust. So that is part A of that question. Part B of the question reads, the following are the financial statements of Utajiri Limited for the 2 years ended 30th September 2022 and September 2023. So we have the statement of profit or loss for the year ended 30th September. We have records for the 2 years in separate columns. Then there is also the statement of financial position as of 30th September for the 2 years. That is 2022 and 2023. Then down the statement of financial position, we have required, compute the following ratios for the years ended 30th September 2022 and 30th September 2023. Assume a 365 year, assume a 65 day year. Assume a 365 day year. So the first ratio that candidates were required to calculate is the current ratio. So we're going to have columns here. Can I write here? Yes, I can write here. So we'll have the ratio. This column is the formula. Then the year 2022 and the year 2023. So the first formula is the current ratio. The formula for current ratio is current assets over current liabilities. That is the formula for current ratio. So we check for the year 2022 from the statement of financial position, the current assets, if you check the statement of financial position, that's 1710. 1710 divide by the current liabilities. Down there, current liabilities, you have tax payable, trade payables, and proposed dividends. That is 745. 745. So when we divide this, we get the current ratio for the year 2022, 2.3. 2.3 is the current ratio for the year 2022. Now, how about 2023? 2023, we have current assets 2195, current liabilities 610. So we divide 3.6. 3.6 times that means that current assets can pay current liabilities in 2022 2.3 times, in 2023 3.6 times. That is an improvement. That is a liquidity ratio. Then the second ratio is a quick ratio. Quick ratio. Quick ratio is equal to current assets minus inventory, total current assets minus inventory, divide current liabilities. So we take the total here, 1710 minus inventory. 2022 inventory is how much? 800. Divide the current liabilities. Current liabilities 745. 745. This is a liquidity ratio. The most liquid assets is 1.2. 1.2 times. Next, we have 2195 minus current inventory for the year 2023. Inventory is 1200. 1200 divide the liability 600. How much do we get? We have 2195 minus 1200 divide 610. This should be 610. 610. 1.6. 1.6 times. That is the second ratio, quick ratio. Quick ratio. Number 3 is average trade receivables collection period. Average trade receivables collection period. Collection period. The formula, this is, let me put it down. Average trade receivables collection period. The formula is average debtors we divide the annual credit sales, times 365. Now, candidates, the formula for average trade receivable collection period is equal to the average debtors divided by annual credit sales times 365. Now, average debtors is calculated by adding the opening debtors plus closing debtors divided by 2. That is the average. Now, for the period 2022, we do not have the opening debtors. What we have here is the closing debtors at the end. We do not have the 2021 data. We only have data for 2022 and 2023. So opening balance for debtors is not given in the question, and therefore we are going to use, we are not to get an average. We not use an average for this 2022, but we are going to calculate the formula using the debtors at the end of the accounting period 2022, which is equal to 490. Divide annual credit sales. Now, the annual credit sales, we pick this annual credit sales from the statement of profit or loss. The first item there is net sales in bracket 80% credit sales. So out of the 4.4 million shown there, 80% represent the credit sales. So we are going to calculate 80% of 4.4. 80% times 4.4. So the annual credit sales is equal to 3520, then we multiply by 365. So the average trade receivable collection period is 51 days. 51 days. 51 days. That is for the year 2022. For the year 2023, candidates, the average debtors will be the closing debtors for 2022, which is the opening debtors for 2023, plus the closing debtors for 2023, then divide by 2. That will give us the average debtors. So from the income, from the statement of financial position, we have the trade receivables, 490 plus 600. So this will be 490 plus 600. That is, we divide this by 2. That will give us the average debtors. Then we divide by the annual credit sales, which will be equal to 80% of 5.1 million. It's 4080. It's 4080 times 365 days. So let me get the average first. It's 49 days. 49 days. That is the average trade receivable collection period. It takes 49 days to collect money from the debtors. Collection period, average collection period. That's why we are using averages. Then the fourth ratio is known as, the fourth ratio is gross profit margin. Gross profit margin, which is equal to the gross profit over sales times 100%. So what is the gross profit here? The gross profit is how much for 2022? It's 22 This is 2200. That's the gross profit. Divide by the sales, 4.4 million times 100%. 50%. 50%. For the year 2023, gross profit is 2250. 2250 divide by the sales, 5100 times 100 is 44%. That is the gross profit margin. Next is the interest cover. 5, interest cover. Interest cover. How do we calculate the interest cover? The interest cover is determined by dividing EBIT or operating profit over the interest charges times that way. It's not a percentage, but that is the formula. EBIT, earnings before interest and tax, or operating profit divided by the interest charges. For the year 2022, we check from the information given. Interest charges, we have the interest expense there of 45, just below the net profit before interest and tax. We have the interest charge, which is 45, and the operating earnings before interest and tax. Earnings before interest and tax, net profit before interest and tax is 1560. For the year 2022, 1560, we divide by the interest charge of 45. That will give us the interest cover. It's 35. 35 times. That means that the earnings before interest and taxation is 45 times stronger. All right, for the year 2022. For the year 2023, the EBIT, earnings before interest and tax, is 1340. 1340 divide by 60. 1340 divide by 60. 1340 divide 60. 23 times stronger. The EBIT is 23 times stronger than the interest charges. That means that interest charges can be paid out of these earnings 23 times for the year 2023. That is interest cover. The next ratio is ROCE, return on capital employed. Return on capital employed. Number 6, return on capital employed. ROCE, return on capital employed. Return on capital employed is calculated by dividing EBIT over capital employed. EBIT over capital employed. Earnings before interest and tax. For the year 2022, we have 15, same as this one here. We divide by capital employed. Capital employed is the same as total assets minus current liabilities. From this question, capital employed is how much? Capital employed is the 1 million plus 915,000, giving us a total of 1915. 1915. 15. This is a percentage. A return is a percentage. times 100, which is equal to 81%. 81. The return is quite high. 81% for the year 2022. For the year 2023, EBIT is 1340. Capital employed 2023. Capital employed 2023 is 2785. 2785 times 100. That will be equal to, this is 48%. 48% is the return on capital employed for the year 2023. Then do we have any other ratio? Yes, earnings per share. Earnings per share. Earnings per share. That is number 7. EPS. Earnings per share. What is the formula? The formula is earnings after tax and interest. Earnings after tax. Earnings after tax and interest. We divide by the number of ordinary shares outstanding. Number of ordinary shares outstanding. What is the earnings after tax and interest? Earnings after tax and interest from the question there, 2022, the net profit after tax and interest is 1,115,000. Is that correct? Yes. How about the number of shares? The number of shares we check from the balance sheet. The capital, ordinary share capital, we can see that the par value is 10 shillings and the total amount is 1 million. 1 million. Therefore, the number of shares will be equal to the 1 million. 1 million divided by 10 shillings. That will give us the number of shares. We divide the total value by the par value. This is 1 million. So we divide, the number of shares will be 100,000. So we have 105 divided by 100. So the earnings per share, the year 2022, is equal to shillings 11 and 15 cents. 11 shillings and 15 cents for the year 2022. For the year 2023, we get the earnings after tax 1040. 1040 earnings after tax. We divide by the number of shares. To calculate the number of shares, we divide the total value of the ordinary share capital by the par value, which is the same as this one here. 100,000 is the number of shares. 100,000 is the number of shares. So we divide 1040 divide by 100. So this will be 10 shillings and 40 cents. 10 shillings and 40 cents. That is the earnings per share. Earnings per share. So every share earns 10 shillings and 40 cents the year 2023, 11 shillings and 15 cents for the year 2022. So that is the solution to the question that was tested in December 2023. This is the last question. We began by outlining the reasons why it is necessary to make adjustments to the accounts at the end of the accounting period. We gave one reason: the matching principle, the accrual accounting, revenue recognition, expense recognition, accurate financial reporting, compliance with accounting standards, then tax compliance. We've gone ahead to calculate 7 ratios. The first one is the current ratio. The formula for current ratio is current assets over current liabilities, and the ratio for 2022 is 2.3 times. This one is 3.6 times. The first two are liquidity ratios. This one is more liquid because you are removing inventory from current assets. So the company can pay the liabilities from more liquid assets for the year 2022 1.2 times, 1.6 times. The third ratio is an activity ratio, which is the average trade receivables collection period, which is calculated by dividing the average debtors over the annual credit sales times 365 days. For the year 2022, the collection period is 51 days. For 2023, 49 days. For the gross profit margin, this is a profitability ratio. It's calculated by dividing gross profit over sales. Gross profit over sales. For the year 2022, the gross profit margin is 50%. That means that out of 100 shillings made, out of 100 shillings sales, 50 shillings is a gross profit for the year 2022. For the year 2023, out of 100 shillings sale, 44 is the gross profit, 44 shillings. Out of 100 sales, shilling sales, 44 is the gross profit. The fifth ratio is the interest cover. Interest cover is calculated by dividing the operating profit, which is also known as the earnings before interest and tax, divided by the interest charges. So for the year 2022, the interest cover is 35 times. That means that EBIT is 35 times stronger than the interest charges for the year 2022 and 23 times stronger in the year 2023. The fifth ratio is the return on capital employed. The return on capital employed is calculated by dividing the EBIT over capital employed, that is earnings before interest and tax over capital employed, or operating profit over capital employed. For the year 2022, the return on capital employed is 81%. For the year 2023, the return on capital employed 48%. Then lastly, we have calculated the earnings per share. The earnings per share is calculated by dividing the earnings after tax and interest over the number of outstanding ordinary shares, number of ordinary shares outstanding. And how do we calculate the number of ordinary shares outstanding? We take the total amount of ordinary share capital divided by the par value of a share. For the year 2022, the earnings per share is 11 shillings and 15 cents. That means that for every share held in a company, the shareholder is entitled to 11 shillings and 15 cents in the year 2022 and 10 shillings and 40 cents in the year 2023. That will mark the end of the revision session, where we've answered question 5, which is the last question. Now, candidates, I urge you to check our books. This is the revision partner. We have answered all questions that were tested in the previous sittings. We've provided the solutions in this book, topically arranged. We have a session for all the questions in topically arranged, organized. Then the answers are presented at the back of the book. That will ease your revision. When you are revising, revise topically. After doing the topic, make sure you go back to the questions, answer the questions. We've also provided these answers in video format. I will, if you check our website, www.manifestepublishers.com, we've answered all past paper questions in video format. So if you have any question, feel free to send in your questions. Below this video, there is a comment section where you can send your questions. We have sufficient resources for you to be able to gain the skills that you require, and also to gain the knowledge and expertise that is required in answering exam questions. Thank you for attending the lesson. God bless you. Bye-bye.